Good morning, everybody. Quick story today. One of the most, scratch that, the most impactful experience in my professional career, to the extent that it informed a lot of the future decisions and understanding in my career. And when I look back at this moment, it's not that I knew it right then, but as I progressed, as I matured in my career, a lot of the things that I realized pointed back to just that moment. And it was a moment in 2008, and I'll never forget it. I was at Merrill Lynch back then, very early in my career, surrounded. The bullpen where I sat was surrounded by corner offices, these corner office guys, these veterans, big offices, big clients, even bigger reputations. They carried themselves like they'd seen it all. And it was one morning during the teeth of the financial crisis in 2008 where one of those advisors one morning came out of his office, shoulders slumped, and announced to anyone within earshot, "I've had enough. I just moved all my clients into cash for a while until things calm down. I'm tired of losing money." Think about that. An advisor, someone entrusted to guide their clients through the storm, had just surrendered to the storm itself. His lack of tolerance for ambiguity, his inability to distinguish between a temporary decline and a permanent loss, didn't just destroy his clients' long-term returns or have the potential to, it destroyed his credibility. And that was the moment in time, even though I didn't realize it fully at first, it was where it all clicked for me. It wasn't a client problem. It wasn't an average investor panicking at the red ink on a monthly statement. It was human nature. And it spares no one, and apparently not even some of the pros. And that realization reshaped my career. It became clear that investing success isn't about intelligence, forecasts. It's not about research necessarily. It's about temperament. And this is something that we talked about a few weeks ago in this series. It's about acknowledging what we don't know and acting with discipline despite that uncertainty. And here we are again, right? Markets are doing okay right now, but questions are always swirling. Are we headed into the next recession at some point? Should we get out of equities before things get worse? You hear them from clients, you hear it from family, you hear it from the media, and you'll keep hearing them, believe me. And over time, the backdrop changes. Not so long ago, it was inflation, interest rates right now, pandemics, elections, but the anxiety is all the same. And our responsibility, amongst others, I feel the greatest responsibility is to tell the truth. And that truth is we don't necessarily know. We don't know what the markets will do this quarter. We don't know when the next recession will begin or end, for that matter. We don't know when the next bottom will be called and when the recovery will be obvious. By the way, neither does anyone else. Not the economists, not the talking heads, not the forecasters who get it right once every millennium and then build a career around it. Acknowledging that we don't know is not a weakness, it's a strength. Because once we stop pretending to know the unknowable, we're free to focus on what does in fact matter. Goals, executed on a discipline, spending the requisite amount of time. And the market itself cannot be timed. Corrections and recessions are not interruptions that necessarily need to be avoided. They're the price of admission. I don't like to focus on statistics, but one that always interests me is since 1980, and I could do the research, and I'm sure this will hold true for prior time periods, the S&P 500 has averaged over that time period about a 14% intra-year decline. So that means every year on average, we're seeing a peak to trough fall of about 14%. And yet, over that same time period, the market, despite that, has compounded north of 10% annually. So these declines, they're not a detour from the process. They are the process. Trying to avoid them by getting out before something bad happens, that's only half the strategy, because then you have to decide when to get back in. And optimism, which drives the impulse to re-enter, never really occurs or never arrives when you're at the bottom of the market. By the time it feels safe again, much of the recovery has already passed. And that's why two impulses don't make a strategy. So our edge as financial advisors is not clairvoyance. It's conviction. It's having the courage to say, we don't know what is going to happen in the next 6 months, but I do know that the markets have and I believe will rise over the long term. I do know that temporary declines are not permanent losses. I do know that owning a mix of equities of some of the strongest, most well-capitalized and well-managed companies on this earth is the way. And I do know that your goals don't depend on what happens in the next 6 months or the next year or 2 years, but what happens over the next 2 to 3 decades. And that's the job, to keep clients invested when it feels hardest, to remind them that forecasts are relevant, to show them that their best chance of success comes not from reacting to headlines, but actually refusing to react at all. So we go back to 2008, and that corner office advisor, he lost his way because he couldn't live with the uncertainty. I get it. Not an excuse. He lacked the tolerance for ambiguity. And if there's one trait that separates the successful investors from everyone else, that's it. The ability to admit what we don't know and still act with confidence on the truths we do know. We don't need to be forecasters. We need to be guides. Guides who embrace the unknown and who help clients withstand it, and who never mistake temporary pain for permanent damage. Because in the end, it's the advisor who says, I don't know, but then follows it up with, but here's what we can and will do. They will always stand taller than the one who pretends otherwise. And that's how we serve. That's how we lead. And that's how we endure. Thank you.